Hello, I'm Rosa del Rosal. I'm a certified public accountant and a certified treasury professional. And today we're going to dive into how to start investing in the stock market. What comes to mind when you think about investing? Is it something like this? Have you considered starting to invest and then thought, nah, that's not for me? I don't know how to read those symbols, let alone pick the right ones, and where does one go to invest anyway? Well, today we're going to talk about how investing is for everyone, and it is not something as daunting as Hollywood portrays it. Investing is not something just the wealthy do. Investing is something one does to become wealthy. So let's dive in. First, let's do a quick overview of what investing involves. What is the stock market? The stock market is the environment in which investment securities are bought and sold. These securities include ownership or stock in companies that are publicly traded in portions known as shares. Securities also include purchasing debt, known as bonds, in which you buy a loan from the government or a company for a certain period of time. You then are paid interest on the value of the bond, and at the end of the bond term, you are paid back the face value of the bond. Other types of securities include derivatives, which are financial contracts for which value is derived from another asset. Don't want to have to learn everything there is to know about these and other types of securities, let alone take a shot at getting it right? Enter the index fund. I want to first disclose that I am not a certified financial advisor and that I highly recommend you consult with one on your investing journey. Okay, back to it. Let's talk about a personal favorite, the Mighty Index Fund. An index fund is a mutual fund that invests in all the investments in an index. An index, such as the S&P 500, is the tracking of the top 500 largest companies in the US being traded in the stock market. This means you're not looking at the multiple different stocks and securities in an index and deciding which to buy and how much or when to sell. The index fund is following the market, and your money is being invested by the fund itself rather than one or a few companies in the market. Think of it as purchasing a basket of goods. The reason I like the S&P 500 index fund is because I'm not a market day trader. There are individuals who have the time and know-how to track individual stocks, analyze them, and trade them on a daily basis. I personally do not. Because I lack the tools and time to invest in daily trading, I look at daily trading like gambling, and I hate losing. Investing in an index fund lets me sleep at night because I know my money is following the market rather than trying to beat it. The historical return of the S&P 500 is around 10%, or just around 7 to 7.5% once you adjust it for inflation. Now, as with any investment, this is not a guarantee, but again, you are investing in a wider market, which provides the added element of diversification. The gains for one period could be negative, while the next they grow and make up for the loss. These funds, like anything traded in the stock market, react to political and social events. So wars, pandemics, and political unrest do and will create swings in the market, albeit temporary. The index fund, like the stock market, grows over the long term. So it's not a get-rich-quick scheme, but a long game. To begin investing, you will need to open an account with a brokerage firm such as Vanguard, Fidelity, or Charles Schwab. The process works somewhat like opening a bank account, and you can do it online. Investing in mutual fund typically has a minimum of $3,000 to $5,000 to open up an account. Once set up and initially funded, you can set up automatic contributions where you can invest a fixed amount regularly of how little or much you can contribute on an ongoing basis. One way to automate contributions to your investment account is to set up a recurring transaction of a set amount on the day your paycheck gets deposited or the day after. Investing right off the bat when you get your paycheck goes in line with the mantra of paying yourself first. If you'd like to see the video I've previously made on paying yourself first, I'm including a link to it below. I'm already saving. Isn't that enough? Saving absolutely has its place and function in your financial strategy. Saving for an emergency is an important first step and an insurance policy against the unexpected. 3 to 6 months of expenses is the sweet spot for saving, but beyond that, your money will do more for you in an investment account, earning you 7% return rather than 3% interest in a high-yield savings account. Savings covers the short term and provides a safety net so you can confidently move to your mid and long term goals of growing your net worth. And this is more effectively done through investing. To paint you a picture of how the wonder of compounding impacts and differs from saving to investing, I will run you two scenarios. If you start saving $500 a month at age 25 and continue to do so until your retirement age of 65, the interest earned, even on high yield savings account, will grow to $452,408. That's including the actual cash you saved of $240,000 if you never missed a deposit. On the other hand, if you invest $500 a month, we're talking the same $240,000 over the life of the investment at a rate of return of 7%, you will end up with a balance of $1,197,000 on your 65th birthday. Same $240,000 over your investing lifetime, almost 5 times the return. Investing is simply one of the best ways to have your money work for you, while all you have to do is create the discipline of being consistent. We will dive into investing for retirement in tax-favored accounts in upcoming videos, but today I wanted to give you an overview of just how much investing in general can contribute to your long-term picture of financial success. Well, I hope I've made a believer out of you. If you have started investing, let me know in the comments how your journey started and how it's going. Don't forget to subscribe for upcoming videos on investing and financial literacy, and I will see you on the next one.